The global financial system is currently experiencing a silent, terrifying transformation, and 99% of retail investors have absolutely no idea what is happening behind their screens. We are no longer just trading stocks. We are participating in an automated economic war. If you look at your portfolio today and wonder why the markets feel so unpredictable, so completely disconnected from economic reality, the answer lies in a highly classified phenomenon known as ghost liquidity. Tonight, we are going inside the server rooms of Manhattan and Frankfurt. I am going to expose exactly how hyper-intelligent artificial intelligence systems are secretly draining the lifeblood out of traditional asset classes, trapping retail capital, and changing the mechanics of wealth transfer forever. My name is Professor Alpha, and if you want to survive the next 24 months in this market, you need to forget everything you think you know about supply and demand. Let me define the battlefield. In traditional finance, liquidity is the lifeblood of the market. It represents the depth of the order book, the actual volume of buyers and sellers waiting at various price points to execute a trade. When liquidity is thick, price movement is smooth. But today, in 2026, the liquidity you see on your broker's application is an illusion. It is ghost liquidity. This term refers to billions of dollars in trading volume generated by high-frequency machine learning algorithms that appear in the order book for microseconds and vanish the exact moment a human investor attempts to execute a trade. To understand how dangerous this is, we must look at BlackRock's crowning achievement, Aladdin. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. It is not just a software, it is a centralized, omniscient digital sovereign that monitors and manages over $21 trillion in global assets. That is greater than the gross domestic product of the United States. Aladdin utilizes massive neural networks to ingest alternative data points simultaneously. Satellite imagery of shipping ports, real-time central bank liquidity flows, credit card transaction feeds, and political sentiment analysis. When Aladdin or similar institutional algorithms like those operated by Citadel or Renaissance Technologies detect a macroeconomic shift, they don't buy or sell like humans do. They deploy automated liquidity scripts. These algorithms place millions of limit orders to artificially inflate the apparent depth of the market. To a retail investor looking at a chart, it appears that there is strong support for a stock or a crypto asset. You buy in, believing the floor is solid. But the millisecond your order hits the exchange, the algorithm pulls its bids. The liquidity evaporates into thin air. The floor disappears, and your portfolio plummets into a vacuum. The algorithm then buys your forced liquidations at a 40% discount. This is not a free market. It is an algorithmic meat grinder. Let me take you back to my days on the institutional side, right before the 2008 financial crash. Back then, we saw the early iterations of quantitative trading. We called them black boxes. They were rigid, rule-based systems. If X happens, sell Y. Even during the dark days of 2008, you could still read the human panic in the tape. You could outsmart the market by understanding human psychology. But today, the machines don't follow rigid rules. They learn in real time through reinforcement learning. They are programmed with a single, brutal, objective function: maximize capital extraction from the ecosystem. They don't panic, they exploit panic. Let's look at the cold, hard mechanics of how they trap you right now. The most lethal weapon in the AI arsenal is natural language processing, linked to high-frequency trading setups. The moment an earnings report is released or a central bank governor speaks, human eyes take at least 10 to 15 seconds to read the first paragraph. An AI system scans the entire document, analyzes the semantic structure, determines the net positive or net negative weight, and executes a $10 million trade in less than 3 milliseconds. By the time you open your laptop to react to the news, the entire move is already over. The algorithm has already pushed the price to its absolute peak, and you are buying the top from a machine that purchased the bottom 3 seconds ago. Furthermore, these systems use alternative data to actively manipulate retail herd behavior. They monitor retail hubs like Reddit's Wall Street Bets, Twitter financial communities, and Telegram groups. They don't just read the posts. They map the network architecture of social contagion. When they detect a rising retail interest in a specific asset, the high-frequency bots create artificial volume spikes. They deliberately trigger technical buy signals on your standard indicators, like the relative strength index or moving average crossovers. They make the chart look incredibly bullish to trigger your fear of missing out, your FOMO. Once the retail herd rushes in with their hard-earned capital, the ghost liquidity vanishes. The institutional short positions are activated, and the trap snaps shut. So, how do you fight an invisible enemy that operates in microseconds? You don't try to beat them on speed. That is a statistical impossibility. Bringing a manual trading strategy to today's market is like bringing a rusted knife to a cybernetic laser battle. To survive and build generational wealth, you must completely pivot your strategy to match the blind spots of the algorithm. My personal investment framework is built upon 3 highly advanced data-driven pillars that bypass algorithmic traps entirely. The first pillar is macro liquidity arbitrage. Algorithms are optimized for micro volatility, seconds, minutes, and days. Their leverage structures are so tight that they cannot hold massive distressed positions for extended periods without risking systemic liquidation. Therefore, your greatest leverage as an individual investor is time horizon expansion, combined with structural asset insulation. Instead of trading highly liquid, heavily manipulated tech stocks on a daily basis, you must identify sectors where institutional capital is fundamentally forced to deploy capital over a 5 to 10-year cycle, regardless of short-term algorithmic volatility. Currently, the smart money is silently rotating into advanced grid infrastructure, deep-sea mineral extraction logistics, and sovereign computational infrastructure, the literal physical hardware that powers these AI servers. These are sectors governed by long-term government contracts and physical constraints, areas where ghost liquidity cannot easily manipulate the underlying value. The second pillar is the utilization of decentralized on-chain architecture and alternative data aggregators. If you are relying on Yahoo Finance, Bloomberg terminal headlines, or standard broker charts, you are consuming lagging indicators that have already been exploited by institutional neural networks. To gain an edge, you must look at raw, immutable data before it is packaged into a media headline. For digital assets and commodities, look at public blockchain ledgers to track wallet clusters belonging to market makers. Use open source Python scripts to track whale wallet movements and structural capital inflows. When you see massive inflows of stablecoins into exchanges without a corresponding price increase, that is the algorithm loading its ammunition. You position yourself before the ghost liquidity script is executed, not after. The third and most critical pillar is algorithmic risk insulation. The absolute death of a retail investor is the emotional adjustment of stop losses. When a machine drives the price down to trigger panic, the human reaction is to widen the stop loss, hoping for a bounce. This is exactly what the algorithm's predictive model expects you to do. It calculates the exact pain threshold of the retail cluster and pushes the price just deep enough to wipe everyone out. To insulate yourself, you must implement mathematical volatility-based position sizing. You use the average true range indicator over a 90-day moving average to calculate the true mathematical noise of an asset. Your risk parameters must be locked electronically, completely detached from your human emotions. If the asset breaches the mathematical boundary, you exit automatically. No hope, no anger, no negotiation. You become as cold and mechanical as the machine on the other side of the screen. Let me be entirely transparent with you. The era of casual investing is over. The traditional wealth transfer is happening right now. And it is the most aggressive transfer of capital in human history. It is a transfer from the uneducated, emotional human to the highly optimized, unemotional machine network. Horizon Alpha was not created to give you generic stock tips or hype up the next meme coin. I built this platform to hand you the structural blueprint required to protect your family's future from these digital predators. To survive this algorithmic meat grinder, you do not need a multi-million-dollar server infrastructure. You need a total tactical evolution of your mindset. You must stop trading like a desperate gambler and start deploying capital like a cold, calculated risk manager. The matrix of the global market is shifting in real time. You can either remain an uneducated statistic, blindly feeding the automated wealth extraction machines of Wall Street billionaires, or you can choose to decode the algorithm, master the rules of the new digital dawn, and insulate your family's future. The division is absolute. Subscribe to Horizon Alpha, activate your notifications, and let us ruthlessly navigate the complex, unyielding reality of wealth together. I am Professor Alpha, and your transition from prey to predator begins right now. Stay disciplined, stay sharp. I will see you in the next chapter.